Okay, what do you think? With rates being this high, should you be paying down your home's mortgage or invest in the current real estate market? Well, perhaps because interest rates are so high, it does give more reason for the traditional mindset to say debt is a bad idea. And you know what? It is if you're not careful. Typically, it does happen when people use borrowed money for things that eventually become useless. But let's talk investments. When you invest, you're aiming to turn your existing money into more money, and this can be a solid strategy for building up more wealth. Now, hold on. There's actually one extra twist where you can combine both paying down your home's mortgage and investing in Toronto real estate. That might be the best solution. Stick around until the end because this twist can be a real game changer and you won't want to miss it. If you're new here, I'm Samantha Chan from Elevate Realty, and our Toronto real estate brokerage wants to help you make smarter real estate investment choices in Toronto. Don't forget to like and subscribe if you enjoy our content. Let's begin. All right, let's break it down with an example. Say you've got $50,000, and if you use that to pay down your home's mortgage at an interest rate of 5%, you would be saving $2,500 annually in interest. Now, as an alternative, you can invest that money into the stock market with an annual return of 10% per year on average, according to historical returns. Now, crunching the numbers on the back of the napkin, you'd be looking at potentially making $5,000 a year here. Now, I know what you're thinking. What about taxes? Well, I'll touch on this a bit, but just as a quick reminder, we're not accountants and you should always consult your accountant before taking up any tax strategies. But let's just do some rough math and say your income tax is at 50%. And in Canada, only half of your capital gains will be taxed. So after taxes, you would still have $3,750, which is better than paying down your home's mortgage. Now, let's take it up a notch. If you're sitting on $250,000, then investing in the Toronto real estate market might end up being the better option. What you can do is use that $250,000 for a down payment and closing costs, and then get an $800,000 mortgage to invest in a $1 million house to rent out. Now, check this out. Here is a very achievable duplex in Toronto with $5,300 in monthly rents. So once you crunch the numbers and annualize it, you'll see that you'll get $13,000 in taxable income a year after paying for your expenses and your mortgage interest. Now, let's assume that that income will be entirely taxed, and for your information, there are ways to reduce it. Just ask your accountant, which would leave you with a net income of $5,500. Now, let's add that to the appreciation side. Even though Toronto's seen an average appreciation of 7% per year over the past 2 decades, we're going to play it safe and go with a much lower 3% annual appreciation in line with long-term inflation. And even with that, you'd get an extra $30,000 in equity each year, untaxed until the time you sell. Now, if we do factor in capital gains tax using rough math, that does translate to a total return, appreciation, and rental income combined of around $29,000 a year. Now, let's compare that to using $250,000 to pay down your mortgage, which ends up saving you $12,500 in interest payments each year. Yes, there is a big difference there, and that is because we're borrowing money to invest. Now, borrowing money to invest is riskier than not doing so, but compared to borrowing money to invest in stocks, real estate is still a much safer choice because you do get rents to help you pay for the cost of borrowing. So after factoring all of this in, you'd still be getting break-even cash flows each month. So there's actually a lot less stress here with real estate, and you end up reducing your investment risk while being able to improve your returns. Now, in the beginning, I did mention a hybrid option, and here it is. Imagine that you're using $250,000 to pay down your home's mortgage, but don't stop there. After that, you would refinance it again and pull it out as a loan to invest with. Now, the strategy is called the Smith maneuver in the real estate investing world. And again, I'd advise that you check with your accountant before you do this. If you do this right, though, the interest that you're paying on your home, which wasn't tax deductible, will now become tax deductible because you are using it for investing purposes. And this ends up improving your returns more. Check this out. Your investment property is paid with all borrowed money. Your mortgage payments do go up here. Cash flows drop on the investment side, but you end up saving on the home side. So at the end of the day, you end up with close to no rental income and minimal income taxes. And once you add all of this up, rough math does give us a total return of $36,500 a year, which might end up being the option with the best returns. All right, let's talk about why Toronto multiplexes are the go-to for many Toronto real estate investors these days. On top of tax perks and rents to help you pay for your borrowing costs, Toronto multiplexes do have much better rent yields compared to Toronto condos and even comparable rent yields to other multiplexes outside of Toronto. Toronto also has its fair share of old houses, and if you have the extra time and money to do so, you can also get pretty good value add gain here if you do decide on taking on renovations. And once you factor in more stable appreciation potential, Toronto is a pretty good choice for those who can afford the market, which does require at least $250,000 of capital to get started. And so if you are interested in digging more into Toronto multiplexes, we know where the best ones are, so just reach out to our team. We're not your typical real estate sales brokerage. Instead, we focus on using numbers to make better real estate decisions in Toronto. And that can mean looking for stronger investments with positive cash flow, thinking about risk management, and looking for ways to boost returns like value add renovations and gentrifying areas. So if you do want to discuss your private real estate situation with us, just head over to this link here to set up a time to chat. You can also check out more content on our website or find us on social media. If you haven't done so already, please like, subscribe, and share this video if you think someone else might like it too. Thanks so much for watching, and I'll see you in the next video. Bye.